David Heath is Duford Insurance Group's face-to-face trainer for brokers. So these are people who are buying leads and running appointments face-to-face, either door knocking them or not, setting appointments, et cetera. And David's here to kind of help go along with this process. We're going to be here about 45 minutes, guys, and I got to run off to an appointment. And David, again, welcome. How you doing today, David?
Hey, doing great. Hope everyone's having an awesome day this morning and going to get out and be very productive today, I hope.
That's what we want. Yeah. So thanks for taking your time, David, to do this. And again, for those of you watching live, I encourage you to put your comments or questions in the chat box below. This is an interactive type of training just as much as it is a presentation on final expense. As you have questions, and there's no dumb questions here because the purpose of this is just basic fundamentals on face-to-face training or face-to-face for final expense. Please post those questions. It can be about leads. It can be about how the sales process works, how you find prospects, how you sell them, kind of the equipment required, the mindset issues. These are all things we're going to talk about today. So as we go through this, feel free to ask those questions. We don't really have a format since this is kind of our first one today. So we're going to kind of be shooting from the hip, making sure that we cover the basics. So let's first start off with motivation here. I think this is an important thing to establish. Why final expense? We'll talk about what final expense is here in a moment. But I want to ask David, if David, you could kind of tell us briefly about your background and length in the business, and then help the audience understand, thinking and being reminded that they're newer or aspiring, brand new. What is it about final expense that attracted you to the business, and why did you decide to sell it?
Okay, well, just a little background on me. Been in the business a long time. I started out with a company doing more of the life insurance. It wasn't designated final expense, and we'll get into what final expense is on this call. But it was designated more to life insurance. I was selling some cancer policies, critical illness, a few of those. I had my life and my health license. Then I went from there over to worksite, what I call worksite. That's going to be my job then, was to go in and talk to business owners, try to set them up, their entire crew, their employees, on a cafeteria plan. Now, that's totally different. That's Section 125. But anyway, you need to know that if you're doing that. But you don't have to know that here. So then I was doing well there. But I sold a few individual policies while I worked for that company, a few whole lives. And man, I saw what I made on. And I was like, wow. On worksite, I'm used to getting 20 to 30%, and I think that's great because of the volume. That's the key to worksite, is volume. Here, it doesn't take near as much volume to make the same amount of money or more. And then after that, I transferred into final expense. I decided that's what I wanted to do, and I worked with a couple MLMs, unfortunately. Was doing well, very well, but just noticed the amount of the percentage of pay I was leaving on the table. And I guess that's kind of, in a nutshell, what's led me to what I do now. And as David said, I am the coach, mentor for the face-to-face broker program here at Duford Insurance Group. And in a nutshell, what we're doing is bringing the old school back. That's my opinion, and Dave can elaborate on that.
Hey, I like that setup. The old school is like your carriers actually cared about you, and your companies cared about you and trained you and developed you and worked a relationship with the idea that you'd be selling for the agency long term. That whole real quick, a little side note here. the business model of insurance used to be you were a company man. You used to work for one company. This is back in the 50s, 60s, and 70s. And then, like a lot of businesses, I think of like the car business, there was a big push to basically reduce legacy costs, retirement, pension plans, et cetera. So a lot of these insurance companies got the idea of basically not having W-2 employees, but then turning them into 1099s, but also embracing the more competitive, capitalistic environment that we were in now, that back then and now, which is embracing the independent model. So all these carriers, inadvertently, in an attempt to be more competitive, to get rid of costs associated with running their business model, it upended the usual relationship and career focus long term that a lot of these carriers had with their agents, and it turned it into this kind of MLM model that's so familiar. And we can get into that as well. But it really started with A.L. Williams back in the 80s, which turned into Primerica. They really took the whole MLM mindset and transitioned it into the keys are over there. Turned it into the model that we see, and it's so prevalent across the board with many of these mega organizations that recruit anybody with a pulse. But all the while, what has been lost in this process is the old school way of training agents one-on-one, developing them into top producers. And we're super stoked, David and I and the whole team, that we've really gone back to the old way, which is the good way, which is taking agents and training them to be top producers, which is, again, is our sales pitch to agents now, is like, hey, if you think training's important, we're all in one-on-one to do that. But back to the basics here. Final expense. It attracted you, David, because it's a high commission payout, definitely a lot higher commission than what you were getting on your work site. Like you said, more of a volume game. Let's, just for the new people, describe in a nutshell what final expense is about from the standpoint of the people we sell to and how basically the product works.
Okay. And one other thing I forgot, I noticed that the underwriting was so simple compared to what I was doing before, and the back end work was so much less. They basically do it for you, where in my previous position, I was having to do all that at night when I got home. But final expense, it is designed to cover burial and cremations. It is designed on a simplified issue chassis. That means, folks, that there's going to be some health questions, but they're not near as invasive as with other policies. There's no blood work to be done, no physicals to be done. Now, why is this good for our clients? Because it makes the companies, they're designed to pay out fast. They're easier to get issued, take less time to get issued, but they're designed to pay out fast to take care of a need such as a cremation, a burial, maybe some leftover bills at the end of life also. I think it's a good way to use it. But I like the way it's designed, because one thing I know by reading the health questions, and they are black and white. What they say is what they say. So once we answer those, we send it into the company. With most e-apps now, we're getting a decision right there on our tablet, which is something I'm not used to, but I'm really liking it. Used to, we'd fill out a paper app, scan it in, or fax it to the company. The underwriting would look at it for a while. They'd make a decision. And then you might be going back out to Miss Jones to say, okay, this did not work. Here's why. But I just think it's more simplified. And to start in this business, there's a lot of different ways to go. Why did I choose final expense? In a nutshell, because it's so much easier and you can make a lot of money, and then you can branch out. Put yourself on a 5-year plan. Final expense is the start. That's not where we have to end, but I got plenty of folks that end here and are happy there. But if you want to branch out later on, that's awesome.
Yeah, I'll add this to the comment made earlier on the product type. It's very important, and we'll get into whole life versus term life, because that's something really important. A lot of people think whole life is terrible. We'll dispel that very quickly in case you've seen Dave Ramsey or Susie Orman or any of those financial gurus. But one of the biggest benefits of final expense is that it's a simplified issue. And you have to understand you think of yourself as an agent, but you're really running a business, right? And one of the most important things about running a business is getting paid like quickly as possible. Okay. Most insurance types. So think of the term insurance that's common that you have to do underwriting for. Like David said, take weeks, sometimes months before even a decision is rendered. And you don't get paid as an agent until the policy is what we call issued, approved, and the client pays the premium for it. The big thing about final expense is that the product is specifically designed and catered to satisfy both the agent and the client's concern of getting the most coverage affordably, fastest, keyword fastest. Again, David's saying, I don't know if you picked up on this, and this is huge if you've been in the business or sold something else. With final expense, we can get an instant decision in the home, face-to-face with the client before we leave from that very first appointment, therefore closing the deal and assuring you're going to get paid. So what does that mean? That translates into faster cash flow, term we use as a business owner, or just faster pay and income for you, the agent. Why is that important? Because it's nice to get paid fast, not have to wait around on a bunch of business pending in hopes that it'll actually turn out well, because the deal is resolved and closed as soon as you end that appointment on the very first phone call for face-to-face. So that's a huge thing, because what I've discovered as a recruiter, I've recruited since 2013, thousands upon thousands of agents. One of the biggest concerns is how fast am I going to get paid? Can I close deals and can I get paid quickly to take care of my bills? Final expense is one of the best products to do just that. That's why I personally recruit agents for the most part directly to final expense, because we all need to make money like yesterday. That's how most of us are in positions of when we first start. Now, David, let's spend some time. I think it's important to talk about the product itself. It's simplified issue. We got that, easy to get approved, not very good, not very lengthy look backs, instant decision, all very important stuff. But it's whole life. And there's some stigma around whole life with the Dave Ramsey types, the financial advisor types. What exactly is whole life? Why do they have a problem with it? But why is it still the best thing for our clients that we could get them instead of, say, term?
And it's funny. My dad is a Dave Ramsey. He sends me every book I think he puts out. But okay, Dave Ramsey is from an era that I call Terminators. I have friends that are from that era, and they were just sold in the business at that time and were told, and it was marketed that way, that term was great, whole life was not. Basically, it got started that way and it grew, evolved. But basically, the term, the low price at first, and then the high face amount is, I think, how it intrigued a lot of people and they bought into that theory. Okay, we'll come back to that. We're going to start on whole life here. This is the best product, folks. Take my advice, take David's. Don't research it yourself. It's the best product for our people. Whole life is designed that if they get a first day full coverage plan, it's going to go into effect on the day that they receive payment at the home office of the insurance company. Now, it's going to go into effect first day. That's big. A lot of terms actually have a 2-year wait in the fine print sometimes. Sometimes they don't. There's a million different kinds of terms. But the whole life is never going to cancel. Term terminates. If you take any words away today, term terminates. Easiest way to explain it. I've heard people explain it as renting a house instead of buying a house with a whole life. But the whole life is never going to cancel by the company, no matter if they get cancer, get something awful, or in a car wreck and can't walk again. It doesn't matter. That simplified issue underwriting was already done prior to any of that. Okay, the price is never going to go up. Terms are set up to buy in cheap, go up to where when you live long enough, you can't afford it and you drop it. I've heard two different numbers here lately. I've heard 93% of terms have not paid out. I've heard 97%. I'm going to look that data up, and a disclaimer, I haven't looked that up yet, folks. I'm going to find a number, because I know when I used to use that back years ago, it was in the 90s, and I had proof of it, 90% range. So the whole life is not going to go up in price. Our people that need this product are on a fixed income. They do not need something that's going to go up, break their budget, because as y'all get to looking through our script, y'all will notice the best coverage, Miss Jones, is the coverage that you have when you die. And the best coverage, the coverage that you have when you die, is going to be what you can afford. Make sense? Yes. So, we've got to remember that also, but the product is based for our people who need guarantees. We're not out gambling. And they're too old to gamble.
And David, what are the two things in life that are guaranteed?
Taxes, and we're gonna die.
But here's the thing, and think about this audience for a second. If you think if you've had this kind of predispositioning, term is everything. Do you know when you're going to die?
No,
you don't. Would you want to take a chance with a term policy that may be cheaper for more coverage, but all of that, what is that worth if you outlive it? Right? Think about it. And that's why we focus on whole life strategies. There's plenty of other reasons. David's brought up the best reasons. The rates never go up. I'm telling you, when you deal with fixed income seniors, if you guys have your moms or grandmoms who still are alive, when you're retired, your mindset shifts because you're getting one check a month for Social Security. You care about budget a lot more. And a little increase in price can be disastrous for a lot of our lower income working class seniors. So having a price that's predictable and normal and customary, and they know exactly what to expect, is so important to somebody who's retired and on a fixed income. And then, of course, not having that risk, that gamble, like David said, of outliving the coverage. That is so critical, because you cannot get that with term. Term, yeah, you may die before it, but we don't know when we're going to die. And the truth is, if you don't know when your final day is, which no human being does, why would you, as a senior planning to pay for funeral expenses, which we know are guaranteed, right? Why would we take a term policy as that tool to solve for that when there's a glaring risk that if you outlive it, you have nothing? Because then at that point, who's to say you could even qualify for anything? Who's to say you can afford those higher prices? Because it does go up as far as when you first take it out in your 80s versus your 60s, let's say. So all of this is to say, this is why in final expense, we look at whole life, not because we're like whole life groupies, like we don't care about products per se, or like from a zealous, irrational position. We're not going to say whole life, if you're stupid if you buy term. That's not what David or I even do. It's because our clients, because of their circumstances in life, whole life is the most appropriate solution to their problem if their concern is final expense coverage. But that doesn't mean if we talk to somebody in their 40s that we're going to push whole life. We just look at our products as tools and options. We'll pull out term when term is appropriate. We'll pull out whole life if it's appropriate. And that's a very important thing that you guys have to embrace, because a lot of these MLMs out there, especially the ones oriented towards IULs or term life insurance, they indoctrinate and brainwash you to think that whole life is like an immoral idea, or that it's wrong and that it's bad. I mean, you would get a lot of that in that term era, where term is the best, whole life is the worst. It's this kind of, like AOLs used to say, stinking thinking. And it's used against you. And so many people have been harmed by just this thinking that term's always appropriate, and who are older, who outlive it, who don't know any better. A comment from the chat. Hey, Rachel. Hey, David, could you explain a scenario and which term may be the best choice for someone? Sure. To clarify, why would Dave Ramsey swear by it? You want to answer that, David?
I would like to, because I have a term.
Yeah,
and I
me too.
want y'all to know I do. Dave's got one too. They're right in the right situation. I've got a term. When we bought our property, my wife and I, we both took out term policies. That way, if we passed during paying for it, one of us did, the other one would not suffer. We got large amounts on that. Now, when the house is paid off and it's going to run out at the same time, I had it correlate with my mortgage, the amount of years. I'm not going to renew it, I don't think, because it's going to be so stinking high.
Yeah.
For one thing, it's going to be a lot higher. I'm a different age. I might be taking a medicine now. You never know. But that's one way to utilize them. If somebody's wanting to, like your business endeavors, I've seen people use it for that. If I were to pass and I don't have someone to run my business, there's got to be money there for my wife to hire someone and get it going, because you still want the income. But now my whole life is specifically for my burial. That's my choice, not cremation, burial. But that's what mine's for. And my wife doesn't have to worry. My kids don't have to worry. I set it up when I'm young. The price is good and affordable for me. And I set it with inflation. I didn't go buy a $10,000 whole life when I bought it. I bought 4 times that, because I don't know when I die what the price of a funeral is going to be. And my wife and I both did all this together. So we're both prepared for the other.
Let me jump in here, Dave.
There's a question too.
Yeah, let me get to that in a second. I'll speak my side of the story here. I have a term insurance policy, and the reason I picked up a term is because my thinking was, if I died prematurely before retirement at age of approximately 60, 65, that my wife and my family would have enough income to supplant what was lost with me dead, right? Because I own a business. I am a cash flow producing machine, right? If I fall over dead, my wife's going to have a hard time flowing into the business, taking control of things, right? So in a sense, this is like a key man coverage, right? So if I die, there's going to be a cash lump sum that my wife gets that will take care of things for many, many years, while all the while providing time to either feed somebody into my role as a business owner, maybe a CEO or a president or a managing operator, to then pay that person, to have the funds to pay that person, but then operate the business to sustain the cash flow from the business. Does that make sense? So, but that's the thing. It's a temporary concern. Why? That's why it's term. Because by the time I get to 60, I'll either have sold out or I've already have built my business and it'll operate on its own, and I'll have enough savings in retirement to protect against that, right? So I don't need the term necessarily. Just like in David's circumstance, he's got a house. He's protecting his mortgage. So if he dies as the breadwinner, his wife is taken care of. They can pay the house off, or his wife can have money on hand to pay the mortgage payment, so she's not evicted or foreclosed on. But that's a temporary problem, because what happens in 20 years or whatever? His house is paid off, right? He doesn't need the term. So the point being, this all goes back to what we talked about. What is the problem we're trying to solve? And it's that problem your prospect has that decides for you which tool in your tool bag of insurance products you're going to use. It just so happens the vast majority of the time when you're dealing with fixed income seniors, their main concern is just, I don't want to burden my loved ones with some kind of expense for my death. And I know I'm going to die. It's a guarantee. I don't know when it's going to happen. Could be young, could be old. And because of that, a whole life product for final expense is the perfect solution, because whole life never cancels. The rates never go up. That's a nice added feature to be convenient as far as budget goes for clients, but it answers the problem that you have a plan that's guaranteed to pay out whenever you die. And likewise, answers the problem of death. You're going to die. Don't know when. Control for it. Because with term, you got to die before a certain point because it'll cancel. Now, real quick here, hopefully that clarifies the reason why. And the main thing is the main thing here for those of you watching live and recording is don't think dogmatic. Don't be like term bad or whole life bad and the others are good or whatever. That's not the point. The point is your products serve a purpose depending on the client's needs, challenges, and problems. And just pick the product that's best suited for them. Okay. Can you speak on converting term life insurance? I'll do this real quick before we move on, Dave. Term insurance does have conversion privileges. What that means is that in the contract of the policy, typically most policies allow you to convert up to the amount of coverage that you have into whole life insurance by a certain deadline. Most term insurance, it's age 65. Sometimes it's age 70. And because if you convert after that, that conversion privilege has expired. And now you're stuck with the term, but you're given an option up to a certain point to, without any underwriting, that's the advantage, to convert that policy up to a percentage of it to whole life. Now, will the premiums go up? Yeah, because you're converting it to whole life. So you're going to probably pay more. But the added feature is you don't have to go through underwriting because what happens, like David said, you take medication, you have health issues, you may not qualify. So that's a nice thing that you should ask if you're getting yourself term insurance or selling term, if the conversion privilege is there. And I will tell you this. This is a big deal I've always had with Primerica. Primerica is so dogmatic about how term is the only product you should sell. If you look at their policies, all of their terms are level premiums. They don't go up till 70. Then they incrementally increase until age 90 to cancel. And I can't tell you how many times, I'm sure David has and other experience have on this call, agents too. You go try to help a person with Primerica. There are 0 conversion term privileges. Your client is stuck with a Primerica plan that terminates. And they should know better, but their dogmatic approach to whole life overrides their, I think, ability to provide a better product. Case in point, real quick story on this, then we'll move on. Lady I met in Chattanooga years ago, super nice lady, had a Primerica plan, started at $55 a month. She was 83 when I saw her, just had open heart surgery, just retired. This lady was like working in a dry cleaner up till 83. I mean, she was a hustler, but she had the open heart. She was tired. You got to hand it to her, right? I mean, when you're that old, it's time to take it easy, And she had a Primerica plan. She was paying $300 a month. She had rated up all those years, and she can't get guaranteed issue anymore because she's too old. And so she's stuck with this term plan, and she just had the hope it wouldn't kill her. And she didn't have the money really because she wasn't working part-time anymore. And she paid all these years, and she could barely keep a hold of it. And that story is hundreds, thousand times over, I'm sure. You don't want your clients in that position. That's why a lot of us don't like term for the older population, because we'll run across that and we're just like, man, that's just the wrong thing to sell somebody who has that need, and it's a shame. So real quick here, we've got about 15 minutes left, David, so I want to hit on all these things. So we talked about underwriting with final expense, simplified issue. We talked about the marketplace of seniors, fixed income. I want to add really quickly to that. For our market, one of the things that's great about the final expense product, you're selling to people who are guaranteed to get an income. You don't have to worry about the undulations of the economy as much. Why? Because, if the economy goes bad, people lose their jobs. But Uncle Sam pays Social Security on time, on budget, has been since the 30s or 40s, since its inception. So you're in a position to selling a product to a person who knows they need it because they're going to die, probably don't have a lot of money saved up, and they're not as much in flux with the health or the lack of health of the economy. I started during the Great Recession in 2011, selling face-to-face. It was the best decision I made because a lot of business models like my personal training business were getting crushed. Final expense was growing great. I was doing fantastic, as it still is right now with all this uncertainty in the economy. So there's a stability effect that you get. Couple that with the fact that the baby boomer population is retiring in droves and will for the next 10 to 15, even 20 years. The percentage of the population is growing from like 11, 12%, 65 and over to like 17 to 18%, right? And then there's like 10 to 11,000 people a day hitting 65 for the next 10 to 15 years. Think about that. Why is that important? Because all these people are in retirement mode. Their mindset is shifting. They're thinking about dying. They're thinking about being prepared to die financially. And so a final expense product is now on the minds of many more people and continuously will be. So you're in a position We have a growing market. You also, as insurance agents, the average insurance agent is 60 years old average. That's probably come down in recent years as there have been more people getting into it. But the point of that is a lot of people are looking for the door in the insurance business. They're looking to retire. They don't want to, you get into insurance because you don't want to like work till your last breath. You want to have a little autonomy, freedom to do other things besides work. So a lot of these guys, predominantly males, I'm sure some females in the mix too, are looking for a retirement situation. So that means more prospects, less competition. It's a great thing to be in, demographically, fundamentally, in the basics of the business. So just wanted to mention that too. Let's see what else here. Man, there's so much to cover here in so little time, David. So I want you to speak on one thing that's really important about this business, is talking about the difference between captive and independent. You've been on the captive side. You're now on the independent side. A lot of agents don't understand the difference here and what it means for the agent and the client. Can you explain the basics of captive versus independence on the final expense business, and why one agent want to do one or the other?
Yeah. And we may have to do a part 2, Dave.
I think so.
But yeah, there is just a lot to talk about, folks. There's a lot of good stuff. Captive versus independent. Captive means you are going to sell for one company, that you are going to sell whatever product, and probably singular product, they sell. They might have multiple products, but you're not going to be able to do anything outside of that company. Now, independent, which we are, and with captive, they won't let you contract with anybody else. That's not allowed. You can only contract through them. Independent, you're a broker essentially, which means you have a wide array of carriers to choose from. We're going to be able to have niche carriers that work for just some certain health conditions. To me, the independent side is just giving your clients better options, more options. And I was captive for a good while. I sold just one product. I did fine selling one product, but you know what? I did my clients the best I could. But knowing what I know now, I did not give some of them the best alternative out there, probably. But with what I had, I gave them the best I could offer. So you can do a lot more with the broker side of it, with the independent. And it just gives you more freedom, because as you do this, you'll figure out this carrier's good for this medication. This carrier's good for this. And after a while, you built an arsenal where when you're talking to clients and underwriting them in the house, in your mind, you're knowing exactly what's best for them. And being captive, I could not always make that last statement.
Yeah, this is a really important thing that you guys have to understand. There's different ways to do business, and I'm not suggesting that captive is like immoral or bad per se, but one of the things that you have to decide, that you have to realize with insurance carriers, is they won't accept all health conditions, right? So just because somebody wants to buy doesn't mean you can get the client that particular coverage with the carrier, because they may have restrictions on medication use, like David said, health condition history, et cetera. If you're a captive agent, typically you're with one carrier, and that one carrier has a set of rules that you have to align to. If the carrier has a particular condition that's not acceptable, you may inadvertently have to put that client with a subpar product with your captive company than what you could get if you're what's called an independent or broker agent. So what we do at Duford Insurance Group for our face-to-face and telesales agents, we're brokers. That means we're not married to one company. We have access to several dozen. Now, we start our agents typically with just 3, but we add more as you start to get more experienced and get some sales under your belt. We don't want to overwhelm you with too much knowledge too soon, but we want to be in a position to where we offer our clients options. This is so important. Here's the thing. If you don't have access to multiple products, you can never guarantee that you're giving your client the best, highest value bang for their buck. And what happens in the final expense world, I don't care what anybody else says, is that you have to operate as an agent that within the next 90 days, another agent is coming behind you. They're going to sit down with your prospect, and he or she is going to try to replace your existing policy you wrote on them. And if you, and this is the point, if you didn't write the best option for the client that you can get based on a number of options you had, you're likely going to get replaced. That causes a chargeback. Now the commission you earn, you have to pay back in part, and usually not all of it, but some of it. And that is never a good thing. So what's the solution? For me and what we operate as, it's to be a broker. It's to have a handful of companies that you can work with so that depending on the health condition, you can assign the best carrier to that client to maximize their happiness and yours too, and to also build a proverbial wall around your client so the other agent that's going to come in the door is not able to replace the deal. Okay, has a much lower chance. Again, a lot of what you don't hear in this business, ladies and gentlemen, you hear about these big numbers of production, you hear about these great people writing all sorts of business, but what you never hear is the follow-up from those agents about the business they lost due to replacements or writing inferior policies. Okay, and a large part of that happening is based off of what you sell or what you don't sell, inferior product choice. Okay, so what we recommend, and this is why we do it at Duford Insurance Group, is as new final expense agents, only work as a broker, only work with agencies that are independent. Okay, you may even have a great sales system with a one product solution, but you're opening yourself up to Pandora's box of all sorts of problems that come from a one trick pony approach to business. There's some benefits to it. It's simpler. You don't have a bunch of carriers to worry about, but there's a lot of long-term consequences you got to be aware of. Okay. Yeah, very, very, very important. David, you want to add to that here? Got about 5 minutes.
One thing I did forget real quick, return on investment. You don't hear those numbers from those companies either.
Yes, that's what really matters. It's the production is a measurement of success, but it's not the income. We have cost of doing business. Carriers pay different commissions based off if you write level or guaranteed issue. There's chargebacks that you got to assume you got to account for in your planning. Our goal for our agents is to have a 4-to-1 return on investment. So for example, if they're brokers and they're not in our free lead program, we do have a free lead program that a lot of agents look into and consider for face-to-face. But if you're a broker, for every dollar you put in to your leads, we want you to get $4 in revenue. So if you put $50,000 over a year, our goal based on our training, coaching, and development of you is to bring back $200,000 in revenue for a net income after expenses of around $150,000. Now, some agents are better than that. Some agents are worse than that. We don't really like anything less than 3-to-1 return on investment. But 4-to-1 is a good goal. It's healthy, it's scalable, and it's a significant income. Now, real quick, last question here. And David, we did have from Yvonne, hey, let's definitely do a part 2. So you will have to come back and maybe do this again here next week. I'll talk to you more about it because there's so much more we haven't really talked about. But I do want to mention very quickly the MLMs. Can you speak on the commission levels for final expense? So commission is going to vary across the board. If you start in our free lead program, our commissions range from 50 to 60%. And why is that low? Well, because we're paying for your leads up front. We're at risk if you don't write business. So the difference is you're going to get paid less. Okay. If you're a broker, generally most of our primary carriers are 100%, some are 110%. And once you write some business, typically 50 policies, we raise you to 110 to 120% for most of the carriers. So and that's based off of that annual premium. So the average case, all said and done, commission is probably going to be $600 to $800, about what I would expect. There's more variables in there, but that's a good kind of starting point. But commissions, there's a couple of things I'll speak on commissions here. And David, you can pop in and we'll wrap it up after this if you have any thoughts on this. Commission is one variable. You got to look at the training. You have to have training, guys, in this business. I can't tell you enough. One-on-one mentorship should be non-negotiable. It allows you to overcome so many learning curve issues that you would otherwise have if you were on your own. That's why we're all in now on the mentorship and training side of the business. You've got to have lead systems, right? You got to have leads that have been vetted that actually work. you can have great training, you can have good commissions, but if your leads suck, you probably will be, spinning your wheels. Okay. You have to have access to good carriers, right? Where the concerns on commission are where you have a low commission, but you don't get any of the extra values. Like if you're there are companies out there that put their agents at 60 or 70%. And guess what? They charge you $35 a lead because their whole system is designed to have you drink copious amounts of Kool-Aid to get you high on their supply and not question the numbers, kind of like what we're talking about. So it just depends, right? It depends on the organization. My advice is to always vet any organization, including ours, if you'd like to. Best way to do it is ask for 3 successful agents' emails or phone numbers and see if you can have a conversation with them just to see what they say. Because look, everybody who recruits is going to say the same thing. Our agency is the best. We think ours is the best, of course, but it's always good to validate that with actually talking to a real life agent. And how they respond to that is going to tell you everything. If they tell you to piss off, like you're not talking to my people, well, what do they got to hide? Obviously something. Would you really want to work with a company like that? But if they provide that information to you willingly and say, hey, say whatever you want, ask whatever you want, you don't need to copy me on the emails like what we do, that should tell you a lot about their character, that they're not afraid of their people talking about them without them present, right? So like a lot of control issues sometimes with these agencies. So these are important factors to consider. Dave, do you want to add anything for wrap it up?
Well, I'd just like to thank everybody for being here. I hope this has been educational. We've definitely got a lot more to talk about, so you might see me again. But just be very cautious with the MLMs, research them. Be very cautious with us too. Research us and compare the two, and y'all make your decision.
Yeah, that's what we're about. There's so many people that fail this business unnecessarily because they're talked into something they've just never really had any experience with. We're all ignorant, right? And part of our mission here is education. It's revealing what they won't tell you and giving you and empowering you with the ability to make the best choice for yourself and your family and for your career, because we don't want you to lose out. David and I both know this business is awesome. There's so much money to be made, but it's not just about the money. It's about the freedom. It's about the autonomy. It's about the way you can control your life and not be a slave to corporate America. Like there's so many good things about this business that if you do it wrong and you rush into love and make bad decisions initially, it can cost you your whole entire opportunity. We don't want to see that happen, whether you join us or not. So thank you, David, for being here. Thank you for all the live attendees. If you guys are interested to learn more about what we do, go to davidduford.com/FAQ. You'll see how final expense face-to-face and telesales works with us and how to apply to a position to work with us. Thanks, everybody, for being here. And David, thank you. Y'all take care.